Banks are facing fragmented regulation in 2026, driven by gaps in AI oversight, tighter digital asset rules, and tougher resilience standards. To explain what will matter most, we have here Basil Wang of Housen and Matthew Driver of MasterCard. Welcome, Basil and Matthew. Let's start with the trends. What trend will most impact banks in 2026?
We need to just take a step back and think about that context, right? Got a lot of margin compression, increased competition for banks, evolving credit and funding risks. You've got these rapid technology, AI, and regulatory changes all happening at the same time within this context of this rising geoeconomic and cyber threats. So while profitability is being stable, there's going to be some stress in the system. So banks need to think really carefully about how they want to approach and balance innovation in this time, and think about really how can they kind of deal with this, a bit of strategy overload. And they're going to have to think about how do they really modernize their risk and compliance environments and really ensure that they're industrializing digital and AI together.
We're going to see increasing adoption of AI across the financial industry and at financial institutions like banks, which is going to result in lowering of costs for banks. Banks should experience some cost savings from adopting AI in backroom and back office functions, but also in customer servicing functions. That could also mean a reduction in headcount at many of the banks that do this. So employees that might need to either retool or acquire proficiency in AI tools and working together with AI. We've already seen layoffs at some of at Block, and some of the big companies and law firms have also laid off people, especially in the software arena for on the basis that they are using AI to replace those functions.
But how exposed would you say are firms to gaps in AI governance today?
I think AI has been moving faster than governance in many institutions, and boards are looking at that, and as they look at resilience and other things, saying, look, is that gap a business risk? We've seen many situations where, look, AI is already being used across fraud detection, customer service risk operations, but all of a sudden, the new technology and generative capabilities are a big priority, and digital transactions are going to double. But not all banks and institutions are really ready. So we really have to think about how do we ensure that we've got the right governance and guardrails in place? And that's what regulators are looking for. The Singapore's MAS has proposed AI risk management guidelines. Hong Kong's expanding its Gen AI sandbox. The critical thing is governance is a really key component. You're going to have to be much more proactive. It's an enabler that is going to allow you to deploy and realize the benefits of AI at scale. Safely and responsibly, because we're going to be held accountable. And so thinking about governance, it has to be intentional and foundational, embedded across the AI lifecycle. And you're going to have to think about AI governance frameworks, building privacy by design, and all those things. Governance is going to be so key because people want to ensure that you've got that trust.
I think they're quite exposed, actually. We've just had a pretty significant hack of a popular AI tool, which allowed a virus to enter people using that tool to drain API keys and drain crypto wallet information. So the cybersecurity risk with AI, especially when you're using agentic AI, is very real and very current. And there will be people who want to exploit. So banks need to be very on top of cybersecurity and audit of any software that they adopt, any AI software particularly, and any use of agents, because there's a recognition right now that agentic AI expose the users to cybersecurity risks and the risk of hacking and data leakage, for example, data privacy issues.
With everything that you've both just mentioned, it seems that there's a lot to consider at the moment. But if you were to make recommendations, what should banks prioritize now to stay ahead in 2026?
Banks will need to sharpen their segment focus. They'll need to industrialize digital and AI, but they'll need to modernize their risk and compliance and control environments so they can take advantage of this structure and reshape their distribution and product economics, because it's going to be a lower margin, more volatile environment. So if you've got that bedrock of a more proactive environment, a customer-concentric framework in all the things that you're doing, whether it's credit, pricing, data, collections with the right degree of governance, you're going to be set up to be able to innovate and deal with the complexity that's coming. But as long as you're really thinking about how you modernize that infrastructure and your governance at the center.
Banks need to think carefully about the solutions that they're taking on. On the one hand, there is a interest in saving costs and it becoming more efficient. On the other hand, banks really need to be especially careful given that they're holding customers' money. So the attractiveness of banks and financial institutions to potential bad actors is very, very high. And so banks need to carefully audit any AI tools that they put in place. They should also think about whether the employees that may be made redundant by the use of AI could be retooled to become AI proficient and to use AI rather than to replace them entirely.
Thank you for your time today, Basil and Matthew. Hope you can both join us again soon.
Thank you.
All right. Thank you so much.
Once again, those were Basil Wang, Managing Partner at Housen, and Matthew Driver, Executive Vice President and Head of Services Asia Pacific at MasterCard. For more news, visit AsianBankingandFinance.net.